Broadcast. Want to welcome everyone to Global Markets Radio Daily Recap. I'm your host, Andrew Spanton. Thursday, June the 7th, 2012, 4 p.m. Eastern. What a day. What a day. Look at the shooting star on the S&P. What a day. Everything started with that Australian number. Wow, was I wrong on that? Holy gamoly. Futures rallied in Asia, in my opinion, off that a little bit. Maybe the word in the know was the Chinese rate cut. Australian dollar rallying almost 500 pips, 450. Wow. Big reversal. S&P's reversing. Gold down big on really nothing. I got to tell you, no MPC move. Bernanke has no freaking clue. What's he smoking? I want some. He's not worried. As we said, the euro would touch the 20 exponential moving average. Back! And reversal. Oh, it's a sell. SOS, baby. Stop yourself out against today's highs. Going into the weekend, these guys can't get their act together. A joke. So all we got from the central bankers this week, forgetting about words. Remember, actions speak louder than words. All we got was what? China. And it was a token 25 basis point move. That's it. No soup for you. Dollar index hitting the 20 EMA also, bouncing off it. Thank you, sir. I have another. Bears, you might have had a very quick hibernation. It's time to come back. Muhammad Al-Ari and Pimco.
Start realizing that they can be willing and able to move, but they're not going to deliver effectiveness. And that's the type of war that we're stuck in.
And of course, they're moving, but they're moving for the wrong reason, right?
Nice
they're moving because things are really weak. In the United States, with all of the stimulus, and in China,
nice
moving because things have actually slowed down. Do you think that was part of a turn in the market sentiment today? What do you think went on today, Mohammed? Because yesterday that powerful rally, and then today we thought we had a second day of it, and yet we gave it up by the close. Not to make you too short-term oriented, because I know you're not.
No, but short-term is important, Maria, and we're talking about it in our investment committee. The market right now is dominated by traders as opposed to investors.
New Zealand.
And traders look at high-frequency elements.
Got to get short.
And are in a trade for as long as it's moving. The minute it stops moving, they're out of this trade quickly, and understandably
You're damn right we are.
The problem is this is happening in the context where risk appetites are low.
Dollar Canada, big number tomorrow. Employment data, I'm tempted to say it's going to suck. But look at Australia. I mean, I've been dead wrong. Bad number, Canada. Buy it. Dollar Canada.
Relatively little information.
Are markets on the same? Are markets and policymakers on the same wavelength when it comes to expectations of further policy measures in terms of boosting valuations? What do you think?
Critical question. I think if you listen carefully to Bernanke, if you listen carefully to what Mario Draghi at the European Central Bank has been saying, you come to the conclusions that policymakers and markets are not in the same place.
Nope.
Policymakers are saying, look, we're willing to move if we have to,
it's not
but
so bad.
Be careful, because it's not clear that we can be totally effective. That's why Bernanke told the Congress today, I would like to shift the burden to you, Congress, because there's a limit to what the Fed can do. Markets aren't there yet. Markets aren't unbundling willingness, ability, and effectiveness. So they react immediately to any signal, and then over time they start adjusting. So I think there is still an inconsistency, and we're going to see.
Shoot first, ask questions later.
All these uncertainties.
Oh, baby.
So what do you see going on right now, Mohammed? I mean, you look at the jobs numbers last Friday, 69,000 new jobs created, way lower than anybody thought. Have we turned a corner in terms of deceleration in this economy?
Gold got killed because there was no printing of money.
We are slowing. And when I say
China rate cut doesn't count.
The US, it's every part in the world. So Europe is in recession. China is slowing.
I'm back to a bear in gold. This candle looks terrible.
So we are in this synchronized slowdown. What investors have to ask is, will this tip us into financial instability as well? And that's particularly important for Europe. But I think that we have to navigate.
Nice outside candle and oil, big time.
The policy response that's going to trigger.
And so how do you want to invest in this environment
got my
then?
finger on the trigger.
I think investors have to be very clear about what they know and invest on that basis, and what they don't know.
I know Greece is going to leave the fucking euro.
If the economy continues to slow,
I know
it will probably trigger a central bank reaction. So you want to be looking at what's...
I just don't know when.
Focusing on in terms of...
I know the euro is toast. Done. No more euro. I just don't know when.
You're making a bet not just on central banks acting, but on central bank delivering outcomes. So this is a world for up-in-quality trades, highly differentiated, and retain optionality, because the market will give you occasion after occasion to pick up good stocks at low prices.
So Mohammed, let me read you one of the quotes from Bernanke today, saying the situation in Europe poses significant risks to the U.S. financial system and economy and must be monitored closely. Tonight. The Fed remains prepared to take action as needed to protect the U.S. financial system and economy in the event that financial stresses escalate. Does that mean we're going to see
103.50? Back. Easy.
I think the probability of QE3 is going up, both because Europe is in such a mess and not getting any better, and because we are...
You're $124.50 easy, and last I checked, Andy Bush told us to buy it.
How much
he was right,
are they willing to
but now
take
he's wrong.
Further slowdown? But every day that Europe deteriorates further and we slow, the probability of QE3 goes up.
Yes, it does.
All right, we'll leave it there. Mohammed, great to have you on the program. Thanks so much.
Thanks so much. Kiwi, 60 pips easy. Down to here. Easy. So, I think the yen's reversed also nicely. Euro yen. Hopefully you got that pop up. Par 50. Oh, baby. Nice reversal. Dollar yen. Held strong. Bond yields even came in a little bit. I'll tell you this weekly chart in dollar yen. Let's take a look. If they could close dollar yen above 80, which I don't think they're going to, but if they did, that'd be pretty bullish. Twin Tower bottom. Twin Tower bottom. Above 80, it looks gorgeous. Breaks all downtrend channel lines. Hello. Hello. Dollar yen looks good. Aussie yen. Monster reversal. Thank you, sir. May I have another? That's a weekly chart. That's not the daily. Daily. Nice. Doji. Nice shooting star. Love it. It don't get no better than that. Sell on strength. Maybe you get a pop. Lovely. Gorgeous. Sell. All the yens. Luna yen. Big reversal there. We've gone up 1, 2, 3, 4 days in a row. We've now taken out this monster meltdown. We're going back down, people. It's a bear market. This is what you love to see. Sell into the bounce. That's all I have to say. Now, as far as, again, Bernanke today, excuse me, the MPC today, they don't get it. But, you know, they seem to think they have time. And for them, if things collapse, they can always do a Sunday night coordinated intervention not on the calendar. So I guess from that standpoint, sure they could. They certainly could. But in my opinion, for central banks around the world to be so nonchalant, to be so carefree about the pending collapse in Europe, absolutely, in my opinion, is irresponsible and disgusting. Euro sterling looks like it's rolling back over. Cannot get over 81.50. It's a sell on strength. Anything. 20, 30 pips, sell. We are not getting through 81.50. No siree, Bob. Oh, no. Euro Canada came back a little bit. No real Momo there. Big day for Canada tomorrow. Big. And I'll tell you what. You want to know what turned today? Pound Aussie. Pound Kiwi. monster reversals. I love these trades. Pound Kiwi, hell yeah. Look at the reversal, baby. Love it. Love it. Break it down to break it out. If I'm right, and we're going to go back down, and gold was down nicely, oil was down nicely, commodity currencies are the place to be short. Back in the fold, baby. Oh, yeah. So there you have it. Remember, Thursday is my last recording for the week. Hopefully, you folks will have a great weekend. Remember, email me, info@globalfxllc.com. Love to hear your comments, your questions, anything. I'll read it online. And follow me on Facebook at Voice of Forex. Follow me on YouTube, Voice of Forex. And follow me on Twitter. That's the one you want. Voice of Forex. So, we got numbers coming out tonight. The big numbers I see really Canadian. Trade balance numbers, Australia, Canada, U.S., producer prices out of London, inflation expectations out of London could be important. German trade balance, maybe. But I'll tell you what. The number you really want to be looking at is on Saturday, and that is weird. China industrial production number coming out on Saturday is supposed to be 9.8%. I got to tell you, if that number comes in under 10%, that is a dramatic, dramatic hit. 2 months in a row. Charles Evans, Federal Reserve.
We'd benefit from more accommodation anyway, even when the economy is growing at 2.5%. I think we can do better than that.
Because things are weak. We saw the jobs numbers on Friday, and this is not a normal recovery.
No, that's true. I mean, the employment numbers had been stronger than that in the months before that, but they've fallen off somewhat. 69,000 is very disappointing. At this point in the recovery, we ought to be getting 300,000. And so that's not going to be enough to improve the unemployment rate, and we need stronger growth. I think with all the risks that we're facing, we would be in a better situation the stronger the economy is so that we could withstand whatever blows might be coming our way or not. And that's why I think more accommodation would be good.
And how does that accommodation take place? Is it buying certain securities? I mean, obviously it's not cutting interest rates at these levels. What is that accommodation specifically?
Right. Well, I think there are two aspects to this. One is in the absence of something clearly happening, like in Europe, I just think we could improve upon our forward guidance. I think that the language about we expect conditions to be such that rates don't have to increase before late 2014. I think we could do better than that if we were to point to economic conditions by which we would take us out of that. I've said 7% unemployment. Others could pick a different number, but being clear on that would be better. Of course, if we're faced with a particular event in Europe or around the world, then I think we would have to have some type of additional accommodation in the form of asset purchases or extending maturity further.
Let me ask you about the measures that you look at in terms of your gauges for Europe. What's most important in terms of really moving the needle, okay, indicating something has changed and we need to actually move forward? What measures do you watch closely?
In Europe?
In Europe.
Well, I mean,
to see how it's impacted the U.S.
Well, I mean, obviously, spreads on sovereign debt are really important in the periphery countries like Spain and the other countries, and just the economic conditions. We all focus on the financial matters, but it's also the case that in Europe things are slowing. In some countries, slowing quite a lot, and I think that's a real concern. And everybody can't continue to improve their situation by exporting more, because somebody has to import things. And so I think Europe has a situation like that. China, emerging markets. We just need better growth.
What is a bigger worry right now? Is it Europe or is it China? I mean, I know Europe is a very big worry, but I mean, how worried are you about China, given the fact that they cut interest rates today? That's certainly indicative of something that of slowdown there.
No, that's right. That's right. I think that the Chinese slowing has been real, but I also think actions like today and other comments that I've heard from business people doing activities in China suggest to me that things on the ground. They're taking actions in order to improve the stimulus in China. So I'm hopeful that that will be of a lesser concern. Europe, on the other hand, is a very big concern because it gets to the heart of monetary policy in all of Europe, fiscal policy there, and you have very real existential questions.
Which is why also Europe, watching oil prices is another major measure there, because even though oil prices have come down, that looks like a positive. It's not necessarily positive because of why they've come down.
Yeah, that's right. I mean, oil prices are going to be driven by the demand on scarce resources, and so if the global economy slows, then there's less of a demand for that, and oil prices have gone down. We'd all like lower gas prices so that we don't have to pay as much out of our budget, but it'd be nice if they went down for the right reason as opposed to just things are slowing.
I want to get your take on the fiscal cliff and sort of this concern that everybody has that the tax cuts are going away and the spending programs are going away at year end. But first, react to what President Clinton told us this week when I asked him about where we are in this economy. He actually mentioned recession. Listen to this.
They're still pretty low, the government spending levels. But I think they look high because there's a recession, so the taxes look lower than they really would be if we had 2.5–3% growth, and the spending is higher than it would be if we had 2.5–3% growth because there are so many people getting food stamps, so many people getting unemployment, so many people on Medicaid.
Yeah. Are we? I know technically we're not.
More people on food stamps ever in the history of this country.
Well, strictly speaking, I think the economy is still growing, and I'm still looking for 2.5% growth. But I'm very concerned about rates of unemployment, the tremendous resource slack that is out there. All
right, whatever. Listen, bottom line is this. Watch out for China number that could be better than expected. That's my big concern on Saturday. I think you're best off going home over the weekend flat, barring any news that happens in the next 24 hours. I'm nervous about those China numbers. And if we get a gap up on Sunday night on those good numbers, good opportunity to sell. And hey, remember, just because you get a hammer, you need bullish engulfing. We have to take out today's lows and today's highs to get momentum one way or the other. So if we close above 82.50, it's going to be very bullish for the Dixie. And just like the euro, should we close below 125.50, that's going to look very bearish. Very bearish, under 125.30, around there. So that's it. All right, everyone, try my product. Have a great weekend. Please do not vote for Obama in the next election. Save the United States. Yes, I said it. Oh, baby. Andrew Spanton, Global Markets Radio, the only voice you'll ever need, who truly loves to make you money. You should have done well today. Bye-bye.